the main theme of the last couple of weeks has been the Fed, its interest rate policy, and the effect of that policy on risk assets. For us, this is not just a theme that we follow very intensely. We believe this is probably the single most important situation in for a long time. So it's worth thinking about this a little bit deeply. Before we go there, let's give the update. We are July 1st, 2020. This is the Not Even Wrong podcast. I'm Krim Delko. We finished the second quarter up 79%. The market was down 4%, so we outperformed by 83% the second quarter. Since the last update, we've been up 22%. We went from 62 to 84. The market is up 3.5%. So we're outperforming by 87.5%. This is July 1st. So we added another 4.5% outperformance on July 1st versus June 30th, the second quarter. That's why there's a little discrepancy. But fundamentally, so quarter two up 79%, market down 4%. We're outperforming by 83%. This is the situation. Our main contributor in the last couple of days, as was for the whole year, is Tesla. And the news out of Tesla is actually not that much other than a very high probability that they will have very good delivery numbers and potentially a profit in this quarter. This has been driving the stock. I think the inclusion in the S&P 500, if they are profitable, is driving some front running as well. But we really think that the fundamental reason why Tesla is doing well is actually even deeper, and it has to do with the current situation in risk assets. And that is also the topic I want to talk about today. It is the Fed, the fact that we have zero real interest rates, the fact that we have pretty much no volatility left in the interest rate market because the Fed not just controls the short end, which is zero, but also has an eye on the curve. So controlling the curve in plain English just means we don't allow any volatility anymore in the interest rate market. We will just manage the curve as we deem necessary. And that has huge implications for risk assets because in a simple way, you take volatility out of one place, the big place, which is the interest rate market, and it's just going to dissipate into another market, which is risk assets. In physics terms, and I've been talking a lot about finding the right vocabulary for investing. So here's one where we can use the word, the concept of entropy in physics, which means sort of a measure of uncertainty, a measure of possibilities. So if we take entropy out of one market, it just doesn't just disappear. It will go into another market. So in other words, if you take entropy out of the interest rate market, then the entropy in the risk asset markets, i.e. equities, commodities, real estate, things like that, they go up. So the possibilities go up, volatility goes up, potential goes up. Now, that means, at least in the near term, probably rising prices. And that's also driven by liquidity, of course. If you have trillions of dollars which were put in the market, literally helicopter money was put in the market, you have an immediate rise in asset prices. And the first ones to rise are the real growth assets, the assets that don't just grow because demand for them will grow, but they grow because they have real growth. We're talking Tesla here. We're talking stocks like Square, Microsoft, Google, Amazon. I can go on. Boston Beer, MSCI, biotech stocks. These are stocks. These are companies. They have a real agenda besides all the macro stuff. They grow no matter what because they are solving fundamental, difficult, deep problems in society. Some are better, some are worse. You can argue Boston Beer is not really solving a big problem by offering us alcoholized seltzer, but no matter what, in their market, in their segment, in their demand space that they live in, that is a problem that they're solving. MSCI, what are they doing? I mean, creating indices, creating benchmarks, and creating transparency in the equity markets. Is that really so crucial? Well, it is crucial for investors. So it matters a lot, and it matters no matter what. By contrast, a company like General Mills, Coca-Cola, companies like that, they sell commodities, and they don't really add value, in a sense that if they go away, the world will be the same place like before. If you take Square out of the market, I don't think the world will be the same place. If you take Tesla out of the market, I don't think the world will be the same place. So having said all of that, I'm just trying to make the point that our thesis that the interest rate situation is driving the prices of risk asset is based on the fact that before we even start thinking about where the excess liquidity that is created by the Fed is going now, let's be clear about where it should be going, and it should be going exactly where it's going, which is to the real growth assets. So that's why we have a very strong performance of these assets, and we think that will continue simply because the demand by investors for these types of assets is going to keep going. We have a second wave of COVID-19 cases in the US. I think it's almost a foregone conclusion that we're going to have a second wave of stimulus because the economies are not opening up as fast as we thought they would. So we have more liquidity coming. There are some fundamental deep questions about why the Fed is doing what it's doing, if it's the right thing to do. This is not the kind of podcast where we discuss these things, but I just want to highlight a few things. So there's the saying amongst macroeconomists that in situations like this, spend and ask questions later. I think the judgment of this statement depends on the purpose. What is the purpose of the Fed? What is the purpose of the financial system in the first place? And I think I would subscribe to the point that the Fed's main purpose is to keep the financial system stable and keep banks from failing. That is the main purpose of the Fed, and therefore the Fed should be spending as much as they can to keep the banking and the financial system from collapsing. So I think therefore the Fed is doing exactly what it's supposed to be doing. The side effects of that are inflation, and the inflation is happening. It's not happening across the economy like we think in the textbook, like a la Weimar, because the money isn't flowing as fast as we might think theoretically. I mean, if the Fed puts $1 trillion into the economy, it doesn't mean it goes straight $1 trillion into the pockets of every person as proportion of the population or something like that. It's trickling into the economy through different phases, and the first phase is it goes from the Fed to the banks, and then it goes from the banks into let's say the very powerful wealthy asset managers or people who control the money flow, maybe also rich people, and they end up investing into risk assets. So, and then from the risk assets it goes into maybe less risk assets, and then into things like real investments, and in the end into demand in the economy. And therefore this whole process hopefully will get some economic growth, and the downside of it is that we have asset price inflation, particularly in risk assets, and then later on we might have asset price inflation in several other assets, such as, for example, real estate. But we're not there yet. What I'm saying is that we have a cascade of events starting by the Fed, which is doing the right thing, which is saving the financial system, and then we have this cascade of events, as I said, that we can argue has downsides and upsides, but fundamentally it serves a purpose, which is get risk back into the market. You should be taking risk now. This is the time to take risk because everybody's scared. People are sitting home. They don't know what to do with themselves. Work is scarce because we are all scared of the pandemic. So now let's do something risky. Let's invest in R&D. Let's find solutions for the coronavirus. Let's find solution for payment systems without cash. Let's find solutions for remote work. Let's find solutions for transport without fossil fuels. This is the time to do it, and the money is actually trickling into those sectors. So I think the markets are working as far as that's concerned. In that narrow view of the world, where we say, let the financial markets float capital into the spaces where it's most needed. I think this COVID crisis has actually created an effect that is doing exactly that. We have less froth in the market. We have less froth in the market. Froth as defined as money is going into places where it shouldn't be going. I'm using the Marie Antoinette moment as a symbol for that, the example. If you have a Louis XIV style court, which is spending lots of money on things like biscuits and cakes and weddings and parties, the equivalent would be we're investing in companies that are not sustainable, that are not, from a unit economics perspective, viable. We are wasting money on Me Too startups. We are wasting money on Me Too corporations. That is being sucked out of the market. Just look at the performance of stocks like, for example, Lyft or Uber. They are tech stocks. They are innovators. They are using artificial intelligence. They have all the nice things on their slides. But fundamentally, they are not viable companies because their unit economics don't work. And guess what? Their stocks haven't done anything in the last couple of months. While the stocks with real positive unit economics and real value added to the society, Square, Tesla, Boston Beer, MSCI, Lululemon, etc., Amazon, Google, they're doing phenomenal. Some better than others. But what I'm saying is the market is doing the right thing. Gravity is working. The laws of the market, the laws of physics, the laws of nature, Darwin is kicking in, and COVID has helped us actually get there. So in that sense, I think we are in a better place now as investors and even as a society. Even though I know it's painful right now, don't get me wrong, I'm not neglecting the fact that people are scared and some people are even dying or on the brink of dying because of this COVID thing. I'm not saying I'm glad that it happened. But one of the side effects of a crisis like this is that we all sober up. And that has happened. And the market, through its mechanics, is functioning really, really well, at least as the part of the risk asset side of things. That is functioning well. Money is going into places where risk is being taken. And that is a good thing. I think mid to long term, that's a whole different conversation. How is the Fed gonna unwind all these trillions of dollars that it has put on its balance sheet and that is pumping into the economy? Are we gonna see more moral hazard? Are we gonna see sort of anything goes mentality because we know the Fed's gonna bail us out? Yes, that is a risk. But in the short term, we, as I said, are happy that the risk is being taken at the right time in the right places. And we as investors, again, our purpose is to generate wealth by investing in technological disruption with large social impact. We are exactly in that process that the Fed wants us to be, which is we are allocating assets into those risk assets which have large social impact. And that's a good thing. Thank you.